Hello, welcome to the July edition of Smart Money with CSP. As per last time, we thought best to start off with welcoming some new clients. So a big shout out to Jim, Diane, Tony and Hazel. We really appreciate you having joined the firm and put your faith in the business. And as I mentioned last time, new clients are how we grow, and I think all of those clients have come through referrals from existing clients, which is really pleasing as well. So welcome aboard everybody, and we look forward to the journey ahead. I suppose for this edition of Smart Money, we wanted to focus on the pension reviews that are going to be coming up over the next month or two. So most of our clients with account-based pensions or transition to retirement pensions will be due for a review. And I thought I'd take this opportunity to give you an overview of the key theme of that review, so you can have some time to consider it before you come in and meet us. There's really two key themes that are running through our reviews at the moment, and they are to a degree intertwined. The first is the US equity market. The S&P 500 is trading at somewhere around 2,840, and according to the research that we use through Farrelly's, that's sort of indicating to us a 10-year compound average annual return of about 2.5 to 2.6%. It's kind of the same as a term deposit. Really just indicating that the US equity market is really overvalued at the moment. If you want to jump onto Google and Google up the Robert Shiller PE ratio, the Shiller PE ratio, you can see on that the current Shiller PE ratio is the second highest it's ever been since 1880, higher than it was before the 1929 crash, and the only time it has been higher than it is today is during the dot-com bubble period. So that's just indicating to us that the US market is really overvalued at the moment. So one of our positions at the moment is to trim our US exposure. Our view is when we get markets as overvalued as that, we take a third off the table. In 6 months' time, we take another third off the table, and if they continue to be overvalued after 12 months' time, we try to exit the position in its entirety. So we're certainly not saying the US market is going to fall. What we are saying is that the current valuations we don't really see returns in the current valuations, and let's be honest, we've had some pretty great run out of US equities the last 5 years. I think it's just time to take some profit off the table. The second issue that's kind of intertwined with this is really something that our dashboards are showing us, is given equity returns, future equity returns at the moment are quite low, the question needs to be asked, is it worth continuing to have that level of risk within your portfolio? Really over the last few years, we have used our bucket 1 investments to fund our income payments, and we've let bucket 3 rally, and it's rallied really strongly. There's been some fantastic money to be made. But we're looking at our dashboards at the moment, and one of the modelling we'll take you through is if we move 20%-ish of your money out of B3 and put it into B1, so really take a lot of risk off the table. What we're finding is because the returns between B3 and B1 are so compressed, there's not much difference between them. It's having very little impact on how long the portfolio is going to last. So the longevity at 80% might fall by, 5%, 10%, if we take sort of 30% of your equity risk off the table. So the question we're sort of helping our clients get their heads around is it worth continuing to have so much risk in your portfolio when the benefit of that risk in terms of how long the additional period with which the portfolio can be expected to last is really not that material. So we're having those discussions as well. That certainly doesn't mean that if we take a much more conservative position, that's where we'll stay. If the equity market does have a material correction, sort of 20 to 30%, I don't think is an unreasonable expectation, then we'd probably look to exit some of that B1 back into B3 when that risk starts to be worth it in terms of the extra longevity you can get out of your portfolios. But at this point in time, we're really just struggling to see that at the moment, and I think when you've got all these indicators telling us these issues in the market, I think it'd be remiss of us not to come back to you, our clients, and say, okay, well, this is what the information is. How do we need to best assimilate that into your portfolio to make sure that you're getting the return you need without taking excessive risk? And I suppose that really is the key point. As I said, have a bit of a think about that. Feel free to Google up some of those bits and pieces. We'll attach Magellan's latest newsletter to this Smart Money, and Hamish Douglas goes into some of these risk issues in quite a bit of good detail in that as well. And we'll look forward to catching up with you all over the next month or so as we go through your returns. Of course, any questions you got, or if you want to catch us in the meantime, please feel free to give the office a buzz. We'll talk to you soon. Thank you.